Kia ora everyone. Happy New Year and welcome to 2022. And also welcome to this one-off special panel discussion brought to you by Sharesies. And in case you don't know, Sharesies is a wealth development platform where our purpose is to create financial empowerment for everyone. So today we'll be talking about what's shaping the share markets at the moment and what might be in store for the next 12 months. So by means of introduction, my name is Alice and I'm a financial analyst here at Sharesies, and I'll be running the conversation today. But that also means that I'm in charge of the admin for today's chat. So before we begin, I do have a small legal disclaimer to read out. So investing involves risk. You aren't guaranteed to make money and you might lose the money you started with. Any information that we talk about today is general only and current at the time. If you're looking for help with your investment choices, we do recommend talking to a licensed financial advice provider. And finally, we won't be providing any personalized advice as part of this webinar. Also, please feel free to ask any questions that you have through the Ask a Question just down below. But please don't leave any questions in the chat area as we'll likely miss these. And finally, please be kind and respectful towards our guests and your fellow viewers. Otherwise, we will have to take steps to remove you from the webinar, and we don't want to have to do that. So housekeeping over, and speaking of guests, it's time to introduce our panelists today. So first up, we have Victoria Harris. Victoria is a portfolio manager at Devon Funds, and she's also the co-founder of The Curve, which is an educational platform designed for women to learn more about money. So welcome, Victoria.
Hi, how are you going?
Good, thank you. Thanks for joining us, and thanks for coming back. You've joined us on a few Sharesies webinars, so great to have you here today.
Thanks for having me.
Cool. And so our second guest is John Berry from Pathfinder Asset Management, which is an ethical fund manager. John is the CEO and co-founder of Pathfinder. Great to see you again, John.
Kia ora, Alice, and hello to all your viewers.
Kia ora. Again, great to have you here, and again, someone that you've appeared on a few of our Sharesies webinars as well. And last but not least, joining us today is Leighton Roberts, who is one of Sharesies' co-founders and co-CEOs. Hi, Leighton.
Kia ora, Alice, and kia ora koutou katoa to everyone listening.
Great. Thanks so much for being here today, everyone. And as I mentioned just before, we'll be chatting about the major themes and events that are affecting the share markets at the moment, and what might be in store for 2022. So let's start off by looking at share markets and what they've been doing lately. While here in Aotearoa, some of us might have been enjoying a nice summer holiday. The share markets haven't taken a break. They've kept marching on. So Victoria, for someone who might not have been, checking in on the markets or their portfolios over this time, to quickly recap, how did the year end in 2021 for share markets, and what's been happening since?
Yeah, thanks, Alice. Well, I guess the key thing is that money never sleeps. So, yeah, like you said, unfortunately, it has been a pretty volatile start to the year. I guess taking a step back, so 2021, we did see a lot of activity, particularly in the kind of the second half or the last quarter of the year. We saw a lot of M&A activity across Australia and New Zealand. A lot of companies had a lot of cash, so were buying other businesses, etc. So, it was definitely. I noticed it was a busy time towards the end of the year, and I guess looking at the share market, so the NZX finished marginally down for the year, but that was mainly due to one of the largest holdings in the index, which is Fisher & Paykel, having a pretty tough year. So that throws the index around quite a lot just because of its large weighting. And then over in Aussie, they finished up about 17% for the year. So, much better than what we feared here last year. And then in the US, the S&P was up nearly 30%. So we really lagged in terms of our performance last year. Then looking at 2022, can't quite believe that it's already 2022, but we saw a pretty volatile start to the year, to be honest. And all markets have started weak. So Australia, New Zealand, the S&P 500 down about 5% already the first couple of weeks of the year. And this is mainly due to, I guess we'll kind of touch on it later, but it's all around, the expectation that the US is going to start rate hikes this year. And it's because we've seen, a lot of inflation around the world off the back of COVID and the supply chain disruptions and labor disruptions that's caused. So we're seeing some really large inflation numbers coming through, which has spooked a lot of people and spooked the markets. We've also got Omicron. I don't even know how to say it, but that's kind of spooking the New Zealand market here as well, and what that kind of means for the next kind of 3 to 6 months here. So yeah, there's kind of a lot going on, which is hitting the ground running after a summer holiday, that's for sure.
Yeah, totally. And I know, I was just saying to you all before, I sort of checked in on my investment portfolio after my break and was sort of like, what's been going on? And as you say, there is a lot happening, and we'll sort of do a bit of a deeper dive into some of those things you've just mentioned in a moment. And of course, something that has dominated the news and markets for the past 2 years has been COVID. And sort of, John, looking to the year ahead, how's the pandemic continuing to impact the share market?
It will continue to impact the share market. If we think of, going back 2 years to March 2020, the S&P 500 was off about 30% when COVID first hit. And, so bad news then, but the global economy grew by 6% last year. So it was actually quite a good news story last year. The other thing that was really interesting last year, Victoria nailed it, sort of summarizing how the year was. The other thing I'd just add is volatility was really low last year. And so despite COVID, if we look at the S&P 500, there weren't any dips below 5%, really unusual. There were hardly, there were very few trading days where the S&P 500 fell by more than 2%. And again, that's really, really unusual. So if you're new to investing, what you experienced last year is not necessarily going to be repeated into the future. And COVID is both a threat and an opportunity for business. So it's the same as any major event that happens. We ask ourselves, how's this going to change or disrupt a business? What does that mean for the business's earnings going forward? And it's not always easy to get it right. In 2020, many people will be familiar with Peloton, which is a sort of home cycling software and building community around cycling. That share price went up 4 times in 2020, only to give it up all of it up in 2021. So sometimes it's not obvious how shares are going to behave. But looking forward for this year, short-term supply disruption is going to get worse. Different countries are handling Omicron differently. Like Victoria, I've got to keep remembering to leave the N out of it, Omicron. Supply disruptions are going to get worse before they get better. Some countries like China are trying for elimination still. Some countries like the UK are just letting it rip. Every country is going to be challenged by it. So short-term supply chains will worsen. Medium-term, I'm not a health expert, but the view that we're taking here is that things are going to return to a new normal at some point soon. And looking at a survey of investment managers and professional investors earlier this week, more than half believe that Omicron will bring us closer to what that normal looks like. So rather than Omicron delaying things and making things worse in terms of a return to normal, whatever that means, Omicron is actually bringing us close to that point. So I suppose a positive in that sense. But this year, more disruption, and expect higher volatility than you saw last year.
Leighton or Victoria, anything else to add?
Yeah, I think that's John made some good points. We probably got a bit complacent, to be honest, in terms of volatility, and so this year being a bit more volatile is probably healthy. Creates opportunities as well. And then with Omicron, I think with New Zealand we have an advantage because we can look at Australia and see what's happening there, and it's almost a lead indicator for us. So we do get that advantage in terms of how quickly that Australia can get back to normal. Therefore, that should result in how quickly we can get back to normal once it spreads through New Zealand. So there are a few key positives in terms of looking to Australia for how we can or how quickly we can return to normal.
Yeah, I'll just add, the only thing I'd add, I mean, that's all great information. I feel like I'm learning lots here as well. But I think that the big change for me last year was the change from that we've been in such a cycle of lower interest rates for longer and longer. And, right through the start of COVID, that was the belief, right? And every macro tool that a bank could bring out around the world was used. And, arguably still, we'll see how it plays out. But that looks like it's resulting in the complete opposite of lower for longer. So I think we saw that play out over the last 2 months, more certainty around that. And as a result, some reaction to it for the first time. And I guess that if there's another thing that was unique about the markets and the point we were in was this sort of constant rise, I suppose, for the S&P as an example last year. It was fully supported by banks just not being a place to put money, interest rates being completely unattractive with regards to that, and probably people, maybe complacent is the right word, but certainly less care for price. And we might see that come back in a bit.
So quite closely linked to some of these things that we've been chatting about is inflation, and that was a key theme that started to emerge late last year, specifically the rising rates of inflation. So just as a quick jargon buster, inflation refers to the general rising of prices over time, and so it erodes purchasing power. So say $10 might not get you quite as far as before. So as I said, that rising inflation that was hitting headlines late last year. I mean, John, do you think that inflation will be persistent in 2022? And sort of what are your thoughts there?
Yep. Look, if we think about what's driving inflation, Leighton mentioned, money creation and government spending. On top of that, supply chain disruption. So difficulty in getting goods pushes up prices. And in Europe and the US, energy prices as well had a really big impact on inflation. We think it'll drop from its current levels, depending on which country you're in. 4, 5, 6, 7% will drop slightly, but will remain above what for New Zealand our target is 2%. It will remain above target for some time yet. Everyone's debating, is it transitory, is it permanent? The longer it's transitory, the more permanent it starts looking. But our best guess is we've really got this problem until late this year. So we're stuck with, we've got to factor inflation, higher inflation, above target inflation into our investing decisions because it's not going away anytime soon.
And Leighton, anything else to add there?
I was in banking last time we tried to put interest rates up. I worked in banking and New Zealand led interest rates up in that case. It didn't eventuate. We were cutting the OCR, I think, by 50 or maybe even more basis points within 6 months. And so I think that's shaken any confidence for me, seeing New Zealand at least lead interest rates up and where that is. But I think everyone, if you look around your life right now, you can see inflation. I see, you can experience it. You don't have to look far past the housing market, but even everything we buy, right? And so it's hard to see anything but that increasing. And saying that if the US starts to raise rates, it'll be the first time, really since 2008 that's happened. It'll be interesting to see. I think we're in a lot of unknown territory on the impact of what that'll do across mostly mortgage rates, which will, I think, have a material impact on people's ability to spend. And as a result, hopefully flow through to prices pretty quickly. But it's all very unknown is what I'd say. I was, just before we were talking, and I was thinking this is going to be a super interesting episode to look back on a year because, it just feels more uncertain than ever.
And you raise a good point there around interest rates. I'm keen to come back to that in a moment. But Victoria, perhaps you could explain a bit, from an investing point of view, how does inflation impact different types of investments?
Yeah, well, I guess Leighton kind of summed it up. Being in uncharted territory, it is definitely for me. I haven't been in investing in financial markets where there has been significant inflation or these increasing interest rates. So for me, it's definitely kind of uncharted territory. And we were just talking over the last kind of a couple of days in the office around what companies will benefit, what companies should we be allocating money to, and it's really. It will impact investments, definitely. Higher interest rates definitely impacts investments that have those longer dated cash flows because you're discounting back at a higher rate. You've also got companies where you want to invest in companies with pricing power, really. One of the most obvious ones is supermarkets, for example, because they have the ability to pass on those costs. But the key thing is that it's all right passing on those costs at the top line, but a lot of these companies are going to feel it, at the expense line as well, and getting staff and dealing with those supply chain issues. It does add a lot of costs. So it's really kind of investing in those companies that will be able to manage it the most, I guess. It's I guess having from a retail investor point of view is having a diversified portfolio would be one thing that I would say.
Really interesting.
I'd just
John.
add one thing, Victoria. I'll just say you're absolutely right. Diversified portfolio is important, and across asset classes as well as within asset classes. So if we think about what is inflation going to do for investing, we're already seeing bond markets. It's bad for bonds, particularly long dated bonds. Shares. Victoria talked about pricing power, how important it is, and not a buy or sell recommendation, but an example of Woolworths, for example. They can pass on the costs they have. Primary producers like Costa Group in Australia or Scales in New Zealand, they can pass their costs on. So you're looking for those with companies. History isn't always the greatest guide to the future, but typically in the past, when inflation's been below 5%, it hasn't actually been terrible for equities. It hasn't been really bad. So that's a guide from the past. But like I say, it may not apply in the future. And look at other asset classes. Property, what you're looking for there is, if you're investing in property companies, do they have the ability to raise their rentals in line with inflation? And how long is that going to take them to do? Like, are the rent reviews 3 years out, or can they do that in the short term? The other place people jump to historically is precious metals. And in times of inflation, gold and silver had a bad year last year. So that they shouldn't have. They should have had a good year. They had a bad year. Crypto had a great year. So I'll leave the question with you. Like, is crypto now replacing precious metals? But I don't know. But that was unusual for precious metals to have a bad year last year. But we're talking about shares, but we should think about the wider asset class as well, and we should make sure our portfolio is diversified across all those asset classes.
Definitely, yeah.
Yeah, really good points there. And Leighton, any thoughts?
No, I mean, I think that's pretty well covered. I think the big thing, Victoria touched on it briefly, but diversification. But all things that we've talked about on Lunch Money now for however long we've been doing it, 2 years, are true right now, just like they were then, because we're always talking about the risk event, and we're in that, I guess. So, what's one of the biggest risks to the S&P continuing its nice track up like it did last year? It's inflation, right? That's the biggest one. So how do you mitigate that? You consider diversification. You use time as that's still the most valuable thing you can have. So realizing that. And the final thing I'd say is being really observant. I mean, I'm just trying to think. In university, they used to explain inflation as like the worst type of tax, because it was one you couldn't see. And I think people have to be really conscious of that, because if deposit rates in the banks will start to go up, and you'll look at them and you'll be like, oh, I can get 3 or 4%, which compared to 0.5% last year is going to look extremely attractive. But inflation's, if that's happening at 7% or 8%, and you really have to just be quite conscious of the bit that's happening that you don't see. And I think that's a trap that many people fall into over for a long. I think it's been a big problem for New Zealanders actually when interest rates have been higher. We've had a huge amount of money in term deposits and stuff, less money in assets, and as a result, more people not growing their wealth like they could have in growth assets. So I don't think it's time to be scared or anything like that. It's time to observe, take some of those learnings and put them into practice.
And this completely leads on to the next topic that I was hoping to cover, because sort of in response to these high rates of inflation, and as you've sort of hinted to so far, central banks around the world are signalling that they'll start to raise their rates or their interest rates. And in fact, here in New Zealand, our Reserve Bank already has started to raise the official cash rate. So Leighton, just throwing this to you as a bit of a refresher, are you able to remind us sort of what a central bank is and what they do and how they influence interest rates around the world?
Yeah, I mean, I guess fundamentally a central bank sets monetary policy for a country. So it thinks about cash in the economy. It's they're often considered the lender of last resort. So making sure there is like stability in the economy, maintaining the cash flow. New Zealand specifically, our Reserve Bank is basically mandated. I mean, mostly we hear about inflation as their key mandate, so they're trying to manage that. They also have employment, sort of as their second primary one. But yeah, in a nutshell, they've got a job of trying to keep this under control, and they've got so many levers they can use. And effectively, they're looking for stability and making sure that the currency, in the Reserve Bank's case, that the New Zealand currency can be trusted, can be a good, a trusted holder of assets, so a custodian of it, and ultimately, or most importantly, I suppose, a good holder of value. So, and that's to say that if you arrive at the dairy tomorrow with $10 and you're hoping to get a bottle of milk and some bread and all of that $10 delivers on that for you. So I mean, maybe John or maybe either of you have something more to add, but I think in a nutshell, that's what they're trying to achieve.
Yeah, look, I'd just add, in terms of jargon busting, the terms you'll often hear in the media are fiscal tools and monetary tools. And the way to think about it is fiscal tools are government tools. That's like take money out of the economy by increasing tax, increase money in the economy by government spending more, and a monetary policy is the tools that central banks use, which is increase money supply, reduce or increase interest rates to take money in or out of the economy, quantitative easing, those sort of things. So they sound scary, monetary policy and fiscal policy, but they're really important tools for managing our economy.
Yeah, so John, sort of following on from that, like in the news recently, there's been a lot of talk about the Federal Reserve over in the US and that they're thinking about raising their interest rates. And sort of as Victoria mentioned at the start of our discussion today, that sort of caused a bit of a reaction in the share markets. Are you able to explain a bit about kind of what happened there and why did that impact on share markets?
Yeah, well, look, the simple answer is we've had a world of incredibly low interest rates for a long time. Since GFC, interest rates have been falling or have been at incredibly low levels, and equity investors love that because you're not going to, like Leighton was saying earlier, you're not going to put money in the bank at 1%. You're going to find another opportunity in dividend yield stocks or whatever it may be. Interest rates rising suddenly makes things scarier. So it makes fixed interest more interesting. It also, which Victoria touched on earlier, is around the way we value companies. We're looking at the long-term cash flow of companies. And if you think about a lot of tech stocks, the potential in those companies might be 5 or 10 years away. And so we're saying, okay, that's when their earnings are. But $1 in 10 years is not worth today what I thought it was, in a lower interest rate environment. So I'm going to lower my valuation of that company. I'm going to lower how I value the future earnings of that company. And that's part of the reason why tech in particular has been hit pretty hard because of the valuation of future earnings. And some tech companies have been absolutely smashed. ARC, which is Cathy Wood's, her fund, which a lot of people will be familiar with, is down about half on a year ago, which is tech focused. Yeah,
and Victoria, anything else to add there? That was a great explanation. Thanks, John.
Yeah, no, I agree with all of that. That's why we've kind of seen a lot of these tech names. Yes, they were kind of COVID beneficiaries, so had a fantastic run from an earnings growth perspective. But there was also the valuation part of that as well, which was driven by these low interest rates. Over the last couple of years, and now we're seeing that reverse. We've seen them, particularly the NASDAQ, which is dominated by technology companies, that's come off. I think it's up about 8% year to date. So, we are seeing those tech companies, really feel the pain, and rightly so, because they do have those longer dated cash flows, which impact the valuation.
Yeah, but it's not all disastrous news in the sense, I was looking at the Microsoft price a couple of days ago, and Microsoft price is where it was in mid-October last year. So, it's given up a few months of gains, but it's not completely disastrous. I suppose the thing that worries me a little bit is I'm seeing a lot more talk about is tech in a bubble, and again, the views of some European and US professional investors earlier this week, about half are saying yes, it's in a bubble, and the other half are saying no or don't know. And I can't answer that question for you, but there is that risk of heightened valuations, essentially valuations getting sent to levels that are no longer justified. There was a bit of FOMO in a lot of companies where people jumping in. When FOMO reverses and people panic, you can see a sell-off, which is what we're seeing a little bit in tech. The question is, how much further has it got to run?
That's the big question.
I mean, you've both mentioned tech quite a lot as an industry that's been impacted by this. I mean, as if from what I've been reading, I mean, it seems as though the impact of these higher interest rates, it can be quite varied across different investment types and also different sectors even. I mean, John and Victoria, is that a fair comment to make?
Yeah, I mean, we saw a bit of, you always see rotations going on in the market, and during COVID we saw rotations. When COVID was running rampant, we saw rotations from these COVID beneficiary names to once the vaccine came out, we saw rotation to vaccine beneficiary name. You see these rotations going all the time, and I think one that we saw, we've seen growth outperform for a number of years now, and that's due, one of those reasons is due to the low interest rates, and we're starting to see a bit of a rotation back into value outperforming, so rotation from the growth names into value, and by value I just mean those companies that are have low valuations but also that benefit from rising interest rates, or benefit from the economy, I guess. I guess benefit from rising interest rates. So we are seeing those rotations continue to play out, and it's kind of just the nature of investing in global markets. And then I guess as you go down a bit more granular, there are companies that benefit from rising interest rates and ones that don't. So for example, banks do well in rising interest rate environments, and the financial sector, companies that hold large cash balances, they're obviously, if interest rates go up, they're getting more off that money. And then I guess we've touched on a few kind of sectors and companies to avoid, but dividend paying companies, for example, tend to struggle in rising interest rate environments. And the New Zealand market has got a lot of those. Real estate REITs, so real estate investment trusts, they struggle. And a lot of companies with high debt, also you're now paying more on that debt. So those kind of companies struggle. So there are companies that will benefit and ones that will struggle as we kind of go into this uncharted territory, or this new year with with interest rates rising.
And Leighton, I mean, from an investor point of view, what are some steps that they can take to sort of look at their portfolios and evaluate kind of how, I guess, interest rates might impact their portfolio, and, what can they do to protect themselves from these changes?
Yeah, I guess like what I said earlier, it's all those tools that we've been talking about for a long time. If there was a thing that I'd say to look at right now, it's really time horizon. Because if you were prepared to accept the risk over 3 or 4 years, against 1% in the bank or something, the chance of you making a bit more in the in equities over that time period, that may change a little bit. So if it's within 3 to 5 years, cash and bonds are probably starting to look a bit more attractive than what they were not so long ago. But I think in the long term, look, I mean, if you look at something that's literally a company by its very nature exists, one of its things to do is to make money, right? And part of that is making more money than its costs, and inflation is a cost of a company. So stocks are still a great option regardless, and we've talked about some of those companies that will perform very well in there. I mean, banks are a great example, and I think in the tech space as well, it'll be interesting to see, because it's been such an opportunity in the user play, and tech has moved so far forward. So right now, I personally feel like we're in a bit of a reactionary zone because we don't quite know what the answers are, but it will settle, it'll work itself out, and we'll understand it a bit better. So the key thing to look at, I think, is stick to the diversification and the risk strategies and what those are, but just really look at those time horizons. It's like, just make sure that you don't need the money in a year or two, that you've got somewhere a bit risky, and if it's already dropped and your strategy is 20 years, then enjoy some discounted prices for a while, because maybe we've just been paying a bit over the odds for the last year in those dollar cost averaging strategies and stuff.
Really good pointers there. And John and Victoria, I mean, you both kind of mentioned a bit about market volatility right at the start of our chat today. I guess, what can investors do to prepare themselves for, uncertainty or market volatility, if this year brings some of that?
I guess touching on what Leighton said, you got to take a long-term view when investing. I know we've talked about what we can expect for 2022, but it's really, you need to take a long-term view in investing, and it's all about buying quality companies or investing in, quality investments that, will continue to grow earnings and outperform is kind of my strategy, and also having a balanced portfolio. So, whether that's diversifying across companies, asset classes, having that balanced approach, but it's also not to get too reactionary. I think it's we haven't had a lot of volatility, and so now we're seeing a little bit, and we're kind of getting a bit nervous. And it's but volatility in markets is natural, and it's like I said at the beginning, it creates opportunities. So if there's any companies you've had your eye on that that have pulled back, and then you can maybe dip your toe in and start investing in them, or it does create opportunities in that sense. So but if you're taking a long-term view, then really that this kind of volatility is just kind of part and parcel of investing, really.
Yeah, look, I'd probably just add to that, which is really probably just repeating what Victoria and Leighton have said, but I think of it in two ways, sort of the high-level strategic and then the lower-level sort of tactical. And at a high-level strategic, most important thing is to understand yourself as an investor. Like, how do you cope with stress? Do you stop sleeping and want to sell everything? Because that's a problem for your investing if that's how you react. But you've got to understand how you're going to react when markets do come under stress. You've got to understand how much risk you can take as an investor, how much risk you should be taking, which again comes down to your time horizon, which Leighton talked about, and also your objectives for investing. Like, what are you saving for? Are you saving for what sort of goal, and over what time? So at a high level, understand yourself, understand why you're investing, and then more tactically, research-based decisions. We talk a lot at Pathfinder about process, and it's about creating repeatable decisions, leaving emotion out of it. So you're using research, you're making objective decisions, you're not just reacting to the news that you read overnight. Diversity of holdings versus concentration of holdings, and a good strategy in times of volatility, which Leighton mentioned, averaging out, and that's a great strategy when you've got volatility. And everyone's got a KiwiSaver. If you're putting money in every month and your employer's putting money in, you are averaging in. You're going to get the average price over the year as every month you put more money in. But rather than, if you think the market's going to be more volatile, and most commentators will say 2022 is going to be more volatile, if you're concerned about, if I jump in now, it might be 10% lower, it might be 10% higher, but it could be 10% lower in a few months. Maybe put a chunk in now, chunk in a couple of months, spread it out, average it in over time.
All really good pointers here, and good reminders for people, just when they're looking at their investment portfolio and deciding what to invest in, and how to get started as well. So thank you all. I am quite conscious of time, as we do have a bunch of questions from people who are listening in. So perhaps let's move on to those now. And this first question actually relates quite nicely to some of those points you were just making around dollar cost averaging. New investor here. I can't afford to invest large amounts, so I'm doing a little bit every pay cycle. What are some tips for investors investing small amounts regularly? I guess some things to consider when they're looking at their investment portfolio and their investment decisions. Perhaps Leighton, any thoughts?
Yeah, I mean, I'm one of those people, so welcome to the club. I've done $50 a week since I was 17, and I've got two kids, a 3-year-old and a 1-year-old, and I put $5 a week in for each of them, and I'm not going to change that ever, just to prove that can work as a great wealth development tool. So, look, I think you're bang on already with what you're doing. So what you can afford regularly, and it's going to be very hard to go wrong from there. So I wouldn't stress too much about the rest of it, but just think about what your objectives are. So, if you like picking stocks, then that's what you should do, because I think whatever can continue to engage you in that process, then use it. Just don't panic on the sell front. If it's a good, if it's a good company when you buy it, and you relook at it the next week and it's still a good company, but the price has changed a little bit, you don't need to react to that at all. You just keep on going. If picking stocks is not your thing, then those the auto invest features that like Sharesies have are very good into funds, or you can select, and that way you can sort of just leave it go and check on it in a year and see what happens. But ultimately, with those smaller amounts, the biggest investment for most people starting out is their income in themselves, right? So that you hold, the biggest asset you hold. So putting a little bit away is the most important thing. And I just the thing that worries me about this mostly is how many people worry about what they're going to choose and stuff afterwards, because I really, really think that's the least important part of it. That behavior is just so much more important.
Yeah, and look, I might just add to that, Leighton. The strategy a lot of people use is core and satellite. So think of the bulk of your portfolio going into core, US, New Zealand, broad market exposures, and then satellite is you're learning about investing, you're trying different things, you've got some strong thoughts around, I don't know, tech or healthcare or whatever it may be, and so invest in some of those companies, but just right size it. Particularly when you're learning, just that core part, you're going to ride what the market does, and if you're there for the long term, that's fine, and then have that satellite piece to try different things, and there's no substitute for actually being in the market and investing and making decisions. You can do all the reading you want, but it's actually investing that's really, really important. So I'd encourage people to have at least a small bucket of that satellite where they're trying different ideas.
I like that, core and satellite.
Cool.
Hey, John, I think that this question will be a great one to direct to you. Jill here is really interested in emerging investment trends related to climate change. I guess, what are your thoughts on that?
Look, yes, and when people ask me what are the key trends for the year ahead, sort of that push to green investment, the climate concerns is one of the top on my list. This is not a fad. This is the new reality. Government regulation, consumer preferences are changing our world around a move to lower carbon. New technology, solar is cost competitive with every other form of energy now. That's a game changer. So new technology is changing our world. So we need to think with our investments, how is a company transitioning to a lower carbon world? And if your time horizon for investing is 6 months, maybe not so important, but if your time horizon is a decade, that's actually a really important question. How are airlines transitioning to a lower carbon world? It's going to impact every company. And, if you're a property company, if you've got a lot of coastal property, a low-lying property, you've got to think about in your portfolio, the impacts are going to be everywhere. And it is we're going to see more and more of that going forward in the investment decisions people make. Good question.
Victoria and Leighton, anything?
Yeah, it's much easier to invest in a company that's in a growing industry, or part of a growing trend, than it is to invest in one that's in a declining or a shrinking kind of industry, because it's just much harder to grow. And so I think that's why, personally, I like to invest in sustainable companies, eco-friendly, whatever you want to call it, companies that are either reducing their impact on the environment or having a positive impact on the environment. Because I think, like John said, regulation, consumer preference is all heading that way. And so it's going to become, just a greater and greater part of investing and part of global markets. And I don't think it's a trend that's going away anytime soon at all.
Yeah, and there's kind of two sides to it, which is one side is I can use transition to a low carbon world to make more money. I will avoid coal companies because, like Victoria's saying, it doesn't have a future in terms of growth. So part of it is how do I use these sort of environmental issues to make more money or de-risk my portfolio? The other side of it is actually climate change is a complete risk to our, total risk to our civilization. I want to invest in a way that I feel comfortable with, and that is avoiding harm, but also investing positively in good companies.
Cool. I might just move on to another question here. This is we actually briefly mentioned crypto before, and this question's from Daniel, who's wondering, what are your views on the ways in which and the likelihood of the cryptocurrency market affecting the share market in 2022? And perhaps Leighton, do you have any thoughts on that?
I do have thoughts, but nothing succinct that would be helpful for anyone, which is one of my problems with crypto generally, probably sums it up. Look, I think it's yet to be seen. Well, for me, it's yet to be seen. So I listened to quite a few podcasts on it, and unfortunately, so far, I don't feel like I often come away too much smarter, because I'm still just working out where this world is going. I like to speak to people a lot about it. I just don't profess to understand it. So I think there's a huge momentum of young people behind it, which is really fascinating to me. I think that, hype and momentum can mean a lot. And I think a spark for someone to get into putting their money into something for the future is really exciting too. So that's all I really have to say. Unfortunately, that's very limited, but I just don't think I'm informed enough to be helpful on that.
That's okay. What about John? What about you? Because I believe Pathfinder, you made an investment into a blockchain company or a crypto company a while back. Yeah.
And our KiwiSaver invested in Easy Crypto, and I'm like Leighton. It's super interesting space. Really hard to work out exactly where the long term the winners and losers are going to be. Bitcoin up 60% last year. Fantastic. Who knows what it'll do this year. What I'm interested in as an investor, not being able to choose which of the cryptos is going to be a winner, I'm interested in the infrastructure around it, which is why we invested in Easy Crypto. And the idea of DeFi, particularly in countries where people are not served by traditional or conventional financial systems, the idea of being able to make deposits and loans, microloans through cryptocurrency, I find super interesting. So again, for me, that's the infrastructure around crypto. I think is where the picks and shovels, rather than being the gold miner, is our approach we're taking to crypto.
And how about you, Victoria? Any thoughts?
Yeah, and we get asked this a lot through the curve. We get a lot of questions on crypto and Bitcoin, and I keep coming back to, it's all about investing in what you know and investing in what you understand. And because, at some point it won't go to plan. And if you're left holding an investment that you don't understand anything about, then, you could lose a lot of money. So it's just making sure that, yes, there's people out there that understand it and can see its uses and see its viability in the future. And there's a lot of people that just hear a good story, hear how someone's made so much money, and just want to jump on the bandwagon. I think that's where you need to be careful. It's all about doing your own research, investing in what you know, and therefore you can sleep a lot better at night. So it's just making sure that you don't listen to you don't put all your life savings into a hot tip that you've heard, that you're actually comes to produce.
Yeah, good pointers there. And I think, ones that apply more generally to investing as well, doing your due diligence and, things like that, always important when making investment decisions. I might just make this last question quite a quick fire one, and we'll make it our last one for today. But if house prices are not sustainable in New Zealand, what do you guys think will happen? Will we see more people go into shares as a different investment method, or will people invest less in shares as they cannot access as much money? Leighton, Sharesies recently did some research kind of around investors' attitudes towards money. Perhaps, you've got some thoughts on this.
Yeah, I have so many thoughts on the housing market, that's for sure. And, so the first thing is, we spent a few months living in Sydney last year, and we're still well behind what it's like over there. So that's interesting in itself. There's it'll be interesting to see what a bit of income inflation, which is happening around the place at the moment, will do to affordability and things. And I'm hoping that New Zealand comes out of this with some higher incomes, because we've sort of really fallen behind Australia on that front. With houses in particular, we know that there's less people looking to buy houses, right? That's now fact. So it's and largely we also know that sentiment's not driven less by losing the quarter acre dream and more by the reality of trying to come up with a deposit to buy a house. Just doesn't feel real anymore. That sort of tangibility is gone. So I think that's going to be an amazing problem for companies to solve, and it's something that Sharesies will lend its hand to as well. And with regards to, are people looking to other ways to grow their wealth, then that's absolutely happening. A huge part of more people looking at shares in New Zealand is the price of the housing market, which traditionally been where people invest their money. So we know that a huge part of Sharesies' growth, and lots of other investment places around, is the fact that people are looking for different types of assets. So and there are ways down the track to create similar types of growth models to what housing has done for people. So, and I'm sure that those solutions will come to the fore. I personally haven't lost hope on people being able to afford houses in New Zealand, and I think if we're really smart about it and we put some real energy behind it, then we can make that feel real again. So, to answer the question, what do I think about house prices? I think I remember when I was lucky enough to buy my first house about 7 years ago, and I felt like it was an absolute stretch then. And I can't imagine what it would be like looking at it now if I was to be doing that. So I can appreciate completely the sentiment that people have around the challenges there. And I'm happy to see that people are taking it into their own hands a little bit and putting their money into other growth assets and still making sure there's a path for growing their wealth.
No, that's great. Thank you. Unfortunately, we are out of time, so we will wrap up now. But I just wanted to thank, firstly, everyone for tuning in today. I hope that you've found this chat as insightful and valuable as what I have. And a very special thanks to Victoria, John, and also Leighton for joining us today. This has been a really, really interesting chat. And as you say, will be quite interesting to look back, in a year's time and see how 2022 plays out. Now, for those of you watching, you can watch a replay of this discussion right here on Crowdcast immediately after we sign off. But there will also be a YouTube video uploaded and podcast versions available later today. So thank you, everyone, and please enjoy the rest of your week and stay safe.